What up, guys? You're considering buying your first home and you heard that you can buy a house with less than 20% down, but you gotta pay mortgage insurance. The big mortgage insurance monster that everyone's scared about. Well, in this video, we're gonna break that down. We're gonna talk about mortgage insurance for conventional and FHA financing, the differences. We'll go over some common myths that are out there, how much they cost, all the good stuff. As a reminder, I'm a licensed loan officer here in the state of California, and I do these videos to show you guys that home ownership is still possible. So we'll get right into it. Why is mortgage insurance even needed? So when you buy a home, if you put less than 20% down, lenders and banks are going to consider that higher risk. Why? Because you have less skin in the game. And so in order for them to feel comfortable with issuing you an approval and lending you, close to $500,000, also depending on, where you're buying, they want to make sure that they're protected, right? So mortgage insurance is something that protects the bank or the lender in the event that you decide to go and skip town and miss payments. Essentially what happens is the mortgage insurance company pays out that bank or that lender if you decide to go ahead and default. So one of the common misconceptions, and one of the things I want to say first, there's a common misconception from homebuyers that mortgage insurance protects the buyer of the home, when it actually protects the lender or the bank, again, in the event that you as a home buyer with less than 20% down decide to default on the loan. The next thing is that mortgage insurance is also commonly referred to as PMI, which stands for private mortgage insurance. And this is specific to conventional loans. When it comes to FHA loans, sometimes people still call it PMI or mortgage insurance, but technically it's supposed to be called MIP, mortgage insurance premium. And so with that said, again, mortgage insurance applies to two different types of loans, either conventional financing or FHA financing. And we'll start off with conventional financing and how it works and how the cost of the mortgage insurance is determined. So with conventional financing, if you put 20% down or above, you don't need PMI, you don't need mortgage insurance. But if you do less than that, then you need it. Now, how is the cost of that calculated? Well, the short way to describe it is it's all risk-based. So what that means is that the better your credit score, the better your down payment, the better your debt to income ratios, the better the property type, whether you're a first time home buyer or not. These are all things that are considered when determining how much your PMI or mortgage insurance is going to cost. And so by that same token, the worse these scenarios are, the more expensive and the higher your mortgage insurance is going to be because the lender sees it as higher risk, right? So with conventional financing, if you have a 760 plus credit score and your debt to income ratios are 30 to 40%, your PMI is going to be much cheaper than someone that has a 640 credit score, 100 points less or 120 points less, and a debt to income ratio of 47 or 48, right? Mortgage insurance can be more expensive depending on whether the property that you're buying is a condo or a single family residence. It could be more expensive or cheaper if it's a multifamily property. If you're a first time home buyer or not. For some reason, some of the things that I've seen is that if you're not a first time home buyer, your private mortgage insurance can be relatively cheaper sometimes, because the way that the banks and lenders and the insurance companies see it is you have experience in owning and with a mortgage before, right? So they for some reason that makes them feel a little bit more comfortable. Now, when it comes to mortgage insurance and conventional financing, the mortgage insurance can actually fall off at some point. So what happens with conventional is once you hit 20% of equity, then you can request for that PMI to be removed. You call your lender, call your servicer and say, hey, I believe I have 20% of equity in my home now. Please remove my mortgage insurance. And sometimes they'll remove it right away. Other times they'll want an appraisal done on the property to make sure that you do in fact have 20% of equity, and remove it if you do. Once you get to 22% of equity with conventional financing, lenders and servicers by law are required to go ahead and remove that PMI automatically. So just some example scenarios to show you guys what PMI can look like with conventional financing. And I want to do this specifically because, like I said in the beginning of the video, this is the big PMI monster, the big mortgage insurance monster that everyone's scared about. People think, hey, I want to save 20% down so that I can buy a home, and I don't want to do less than that, because yes, I know you can buy with 3 to 5 or 10% or 15% down, but then I'm going to have mortgage insurance and it's going to be super expensive. And people think that it's like $500, $600, $700, $800, a month to be able to have mortgage insurance, when in reality it can be pretty cheap, especially if you have good credit score. So someone, let's say that's buying a $500,000 home with 5% down and has a credit score of 760 or above, an example scenario would be their mortgage insurance would be 0.4% of that loan amount. So when you do the math, on what that would look like, that would be $1,900 a year in mortgage insurance, which would be $158 a month in PMI. And this is just with 5% down, right? When you go to 10% down, there's a bigger price cut there, right? Where it can be cheaper. It could be, let's say, maybe 20% or 0.2% of the loan amount. So on that same $500,000 home, let's say you do 10% down, the loan amount on this would be $450,000. And let's say your PMI is 0.2% of the loan, your mortgage insurance on this would be $75 a month, right? And so that's pretty cheap, right? I guess when it comes to this, you have to decide, is it worth saving an additional 10% down, depending on how long it might take you to save 10% down more to buy your home to avoid PMI? Or can you get in the door now with $75 a month PMI in this particular scenario, and then just allow your equity to go up and that PMI falls off, right? Or even if you have 20% down or 20% available, if you have to withdraw it from a 401k or an IRA or a stock account, is it better to just leave that money there and come in with minimum down payment with relatively cheap PMI to be able to still own a home, right? So just something to think about there. All risk-based, and the better your scenario is, the cheaper it gets. I've seen private mortgage insurance literally be $20 to $30, $40 for some, scenarios. So the next type of mortgage insurance is when you use an FHA loan. And so we'll go over how it works with FHA. So with FHA financing, the mortgage insurance works a little bit differently. And FHA loans are loans that are backed by the Federal Housing Administration. And they're cool because they allow you to purchase with as low as 3.5% of a down payment. Now, in terms of, what the rate is for the mortgage insurance premium with FHA is the rate. The main difference is that the rate is going to be the same regardless of your credit score. So let's say you buy a $500,000 home with 3.5% down payment and you have an 800 credit score, your mortgage insurance premium is going to be 55 basis points, which is, just over 0.5% of the loan amount, 0.55%, right? So if you have a $500,000 home, 3.5% of a down payment, so your loan amount is going to be $482,500. And so the mortgage insurance on this is going to be $2,653 per year, which is going to end up being $221 a month, right? Baked into your mortgage payment. Now, this is if you have an 800 credit score. If you have a 580 credit score, which is significantly higher risk in my opinion, your mortgage insurance is still gonna be the same. If you have the same type of loan amount, same down payment, all else being the same, it's gonna be the same mortgage insurance rate. So that's the main difference with FHA. And so we'll go over some additional items or additional things to go and keep in mind with FHA, because with FHA financing, typically you have mortgage insurance and it won't fall off. You have to have it on the loan for the life of the loan, unless you start putting more down payment down. But if you go in and use an FHA loan with a standard 3.5% down, which is what many people do, and I would say most people do, then your mortgage insurance is going to stay on for the life of the loan, unless you pay it off or sell the home or refinance into a conventional loan. But if your loan amount is less than $726,000 and your down payment is 3.5% down, your PMI, your MIP, mortgage insurance premium with FHA, is going to be 55 basis points. If your loan amount exceeds $726,000, then the mortgage insurance premium goes up to 0.75%. So it's considered higher risk. So the mortgage insurance is going to be higher in this particular case. So there you have it. I know that was a lot of information. What are the main takeaways here? In my opinion, based on the hundreds of loans that I've done and that I've seen in the scenarios that I've come across with a lot of my clients, is that if your credit scores are relatively higher, I'm talking 740 or above, maybe 720 in some scenarios, depending on your down payment, it's going to be cheaper from a mortgage insurance standpoint to use conventional financing, because it's all risk-based, right? So if your debt to income ratios are low, credit scores are relatively higher, etc., chances are your mortgage insurance is going to be cheaper with conventional. If your credit scores are low 700s, and especially if you go into the 600s, then you almost always are going to want to use an FHA loan, because your mortgage insurance premium is going to be way cheaper with FHA. It's just going to make more sense. The rate is going to be cheaper on the FHA side of things as well. So there are some pros opposed to using an FHA loan in that particular case if your credit scores are in the lower range. So yeah, I hope this was helpful for you guys. As a reminder, I'm a licensed loan officer here in the state of California, and I do these videos to show you guys that homeownership is still possible. And I love working with first-time home buyers who are ready to be homeowners but don't believe they have enough saved. Peace.